It's our great pleasure to welcome back to the show, Cem Karsan from Kai Volatility Advisors. Cem, thanks for coming.
Great being here. Thanks for having me.
I've been looking forward to this for a long time. You piqued my interest, I don't know, maybe 6 months ago when you started talking about dispersion, and I've been on a little bit of rabbit hole trying to understand it. We're going to talk about all those things, but I just want to tell people first and foremost, we're not going to sit around and discuss where the stock market's headed for the next week or the next month. And why don't you tell people that are interested in that where they can find more of kind of those day-to-day plays?
Yeah, best thing to do is come to kaivolatility.com/news. That has all of our media, all of our current thoughts. We do a weekly kind of update to everybody who subscribes to that. And then obviously you can find me on Twitter or X, jam, _croissants. And we usually kind of update people there as things change.
One of the great X accounts out there, or Twitter accounts, if you can understand all the emojis. All right, so let's talk about dispersion. But before we do that, we're going to kind of just start with the structural flows and what you see out there, because I think that might lead to the dispersion trade and how it's setting up. So one of the things that you've been hammering home over the last little while is all the index selling that is coming out of structured products. Could you explain to us what a structured product is and how that's affecting your volatility market?
Yeah, this is incredibly important. A lot of people haven't even thought about this, but this is the first bout of inflation we've had broadly, right, since the 1960s and 70s. And ironically, derivatives and, obviously structured products, which are kind of a part of that whole complex, didn't exist during that time. They were introduced, so the first options were listed in the early 70s, and puts weren't, even listed until much later. So there were no structured products or derivatives during the last inflationary bout. Why does that matter? How are they connected, and what's important about this new environment we're in? Well, options were created in the 70s partially to a great extent for capital efficiency. People wanted to be able to get their 20% yield that they were getting in the 70s while still being able to take market exposure without laying out the money for the asset. That's a big part of the reason of the introduction of derivatives. Not the only reason, but that was part of why it was introduced at that time. Now that interest rates are higher, you have the ability to still get your interest and take market exposure. This happens, all over the market in different ways, but you can get T-bill returns on your cash and still take a call exposure or sell put, buy call, or take all kinds of other positions and take market directional bets. That is very appealing, particularly in a world where some of the actual, market, exposure that people have historically taken in the last 20, 30 years is less appealing as well. Imagine 2-3 years ago, if I came to you and I said, well, yields are, 1.5%, 1%, and I can put, structure some vol selling on top of it that makes 4%. So I can get you a 5% yield per annum. Probably weren't too interested in that, right? Yes, it's a non-correlated trade, but 5%, especially when the market had been returning for about 11 years, over 10%, right?
Right.
Just not very appealing. Why would I sell my equities to do that? Fast forward to now, right? Now you could make 9.5%, 4% plus 5.5%, 9.5% on that same product. And your alternative is an equity market that's gone nowhere and lost money in real terms in the last 2 years, with a lot more structural problems that we and many others talk about. The value proposition of a structured product is just more desirable than it used to be. And so rising interest rates really make it appealing to go into the bond market, right, and get those yields, but also derivatives allow you now, which you didn't have the ability to do in the 70s, to stack a return above that risk-free rate, to use those T-bills and treasuries as collateral for other ways to make money. So a structured product essentially does that. It uses derivatives that are publicly traded. Banks use those to hedge their products that they then issue to individuals and institutions to generate a kind of payout structure that is appealing. There's all kinds of them. Some sell downside, some sell upside, some sell both, some give equity exposure and then sell downside or then sell upside. But almost totally across the board, there is some form of vol selling in the overwhelming majority of them. And the amount of increase in the issuance has been dramatic. So what does that do? That puts the banks that are now issuing these out to institutions in a very, very long vol position, which they then have to go sell back onto the market. So we could go into more detail about it, but from 30,000 feet, that's what's happening. We're seeing dramatic increases in vol compression as a function of this issuance. And it's primarily tied to the equity indexes, which is where these structured products tend to be tied to.
So one of the things that just immediately jumps out, we've had periods of subdued vol before. And that was when we had the XIV crash eventually, but was that also driven by structured product, or are these things that much bigger today than they were 5 years ago, 10 years ago?
So there's a relation here to what happened in 2017. 2017, the vol compression that we saw at the index level and the incredible success of dispersion, so the single list moving more than the index in terms of volatility, were driven by index vol selling. The difference is it was not primarily driven by structured products. It was primarily driven by actual issuance of funds writing of iron condors and all kinds of other vol selling strategies, which had become en vogue. But the majority of those weren't structured notes or structured products. They weren't being invested by single, individual investors as much. A lot of that actually was due to vol selling that was coming from Japan and a couple of other overseas markets, partially because interest rates were lower and people were, reaching for yield in ways. So there's always kind of a vol selling impetus. People want this kind of extra yield. The difference is this is a much more stable, widespread, and broad vol compression that's happening. And it's really being driven by almost all the banks issuing these structured products. In 2017, there were 2, 3, 4 funds, which we can name, that really were focused on selling vol at the index vol level and had become quite big, who were single-handedly in a very illiquid market compressing volatility at the index level. So the two are related, but not the same sellers of vol and not for the same reasons per se.
Does that make this selling of vol actually more stable and less worrisome?
I would agree with that. I think in the short, it almost always ends badly because what it does is it increases the risk appetite and it forces people to take extreme risks that eventually get too big and crowded. That said, things imploding broadly are a function of not just how much vol is being sold, but how concentrated it is, and not just how concentrated, how much broad leverage there is. So if there's a lot of leverage to the position and it's concentrated, that's when things tend to break down. Think about XIV, think about long-term capital management. We can go on and on about kind of the big blowups we've seen over time. When something like this is really dispersed across a whole vast a number of people who are just investing in this, think about a proxy for this would be something like Korea. We saw massively low vol in Korea for decades because the issuance of structured products was so popular among individual investors. You'd have auto callables and all kinds of investments like that, literally sold at your 7-Eleven down the street. And I'm not exaggerating here. Koreans would invest in those things in scale.
Get a Slurpee and a structured note.
Yeah, it's true. And incredibly popular in those markets. And so those would all, for literally decades, made Korean vol by far the cheapest vol. And guess what? The market didn't move in Korea as a result for a long time. So we know this happens. We've seen it in foreign markets. So if structured products became, let's say, wildly popular among The vast majority of investors, let's say, again, I don't see that happening here in the equity market anytime soon, but if they're profitable and successful and the markets don't do particularly well, sure, guess what? People will start investing more in them, and that will continue to have a vol compressing effect. And that is not something we saw in the 60s and 70s. In the 60s and 70s, when we had inflation, people moved to the bond market, and that was vol increasing because it removed liquidity from the equity system. We are seeing that happening as the bond market goes higher. We do see some pull from equities. But the interesting part is we're really having a different experience where liquidity is actually going back, at least to some extent, right back into the middle, into the index. And again, that's really creating almost like this donut where vol is expanding on the outside in the main system, but being pinned right down into the middle of the index in the meantime. And that's really created this incredible dispersion trade that's now worked not just 1-2 years, but really with a short 1 month kind of not working and during COVID really has worked almost now for 7 years, 8 years in dramatic fashion.
Okay, so let's talk about the dispersion trade. And I guess the thing that I just want everyone to just get solid in their mind is that the index vol selling supply has a self-fulfilling prophecy in that the more people that sell vol, the more it is actually subdued to a point, obviously, and it can until it's not. And when that vol selling opened up an opportunity, because there wasn't a lot of moves in the actual index, that basically dispersion books would be short index because it's not moving, and then long the individual names volatility. So first of all, why don't you explain how that trade works? And I've heard you mention that there was a very famous pod shop that actually has 20 different pods doing this trade. Is that correct?
Yeah, and there's more than one, but I named one, and there's one big one that starts with an M and ends at EM that in particular has a lot. Again, I don't want to name the exact number, but definitely double digits. And there are other big ones. All the big names have these pods and shops, not because it's profitable. So it's getting very crowded. And so supply is to some extent meeting demand on this trade more than it ever has. It's still a profitable trade, and to varying degrees over different periods. But yes,
could you explain what it is? Like, could you go through it a little bit more better than I did and kind of walk us through how it works?
Yeah, happy to. So important to note. So this structured product issuance and other vol selling on the index level essentially pins the index. What do we mean by pins the index? Well, if a dealer or a bank or a market maker is long gamma or long options, implied volatility, when the market goes down, they need to buy the market. And when the market goes up, they need to sell the market, right? And what that does is reflexively, the more they're long and the more they need to hedge their book, the more that it reflexively pins the market and keeps it very tight, decompresses the actual realized volatility. Now, we understand that, okay, the index is pinned. Why aren't the single list names also pinned then, right? You'd think the index, which is 500 names, would be in line with the 500 single stocks volatility. Well, it doesn't necessarily work that way. Single list stocks aren't the actual vol centers. The supply and demand of volatility and the movement of those stocks does, by arbitrage, have to be as a whole together, right? Have the same kind of net move, but that they don't have to each be compressed in terms of volatility. There's nothing actually compressing their single volatility. So if there is a death of a CEO, guess what? A stock still has idiosyncratic risk and it goes down. If a company blows out its earnings and doesn't credit well, guess what? That stock still goes up. And so volatility of the single list still moves kind of in line with historical averages and in their own ways while the index is pinned. What that means is broadly the difference between them. There's more volatility in the single list, and the difference between those volatilities is the correlation, right?
Okay.
Now I'll add one extra level, and we kind of talked about this online, but it's not only that those things are still moving in line; it actually and this is kind of counterintuitive, you got to think about this, increases the implied volatility of the total of the single list actually tends to net increase if you add them all together than the index, because the index is pinned. How does that work? That doesn't make a lot of sense. Why would that be the case? Well, think about it. If you have an index that is not moving, that is literally tied to the same price day after day, and you have certain stocks moving in a certain direction, think the Mag 7, right? Move dramatically up because there's all of this buying pressure, and there's actually there's even short volatility in those because customers are buying the calls and speculating, and those still keep ripping up. Okay, well, if those are going up and the index is pinned, what has to happen to the other stocks? They have to go down.
Right.
And so you're not only getting the volatility of those stocks going up, by definition, because the index is pinned, you're forcing even more volatility because you're forcing all the other stocks to move. And they're moving the opposite way, but they're still moving. And the net effect of that is a breakdown in correlation. And this is what we saw in 2017. You alluded to that as kind of a parallel, interesting time when we first saw the biggest profits and dispersion. It was when the index was pinned in 17 due to all the vol selling that was happening then. And we actually saw 30% lower realized volatility in 2017 on the index level than any other time in 125 years of market history. That's how we know This was kind of a very irregular, weird time. To most people, they think 17, nothing happened in 17. 17 was a very historic year in markets. It was incredibly not volatile at the index level. But that was not true at the single list level. The single list level was in line with 125 years of history. It was within one standard deviation of the historical volatility of the single list names. And what that meant was we had a dramatic breakdown in correlation, and we had 30% lower correlation in single list constituents of the index than 125 years of history. That's not a coincidence. That's because when the index is pinned and the non-index are not, that means not only do some stocks have to move that go in one direction because of whatever it is idiosyncratic risk move, but that means the other stocks have to move in the opposite direction. And that's a big takeaway. If you're not thinking about markets or the kind of the market structure that kind of feeds into this, you're kind of missing the bigger picture of why these things are moving. It's not just fundamentals.
So we had Mandy from SIBO on the show, and she used this great example where she said, imagine a 2-stock index that is equal weight, and you know that it's going to be unchanged, because the vol is compressed to the point where it's zero. If one stock goes up 20%, that means the other has to go down 20%. Now, one of the things that I've noticed over the last little while is an increasing kind of negative correlation in that between different groups within the index. And I'm assuming, I used to think it was just some sort of quant shop doing some sort of ARB. And I'm increasingly wondering if it's this correlation trade. And it really clicked for me one day when you started talking about this fact that it's almost a self-fulfilling prophecy, that if you have this correlation occurring, like if you have this index that is being stamped down, that if one goes up, the other has to go down. And it's actually a function of the positioning of the market maker, of the volatility books. And so just like when an option whale comes in and creates volatility around a strike, if they're long the volatility, if they long the market makers, that option, there's going to be subdued volatility around that strike. And if they short the market makers around that strike, it'll be increased volatility. Your argument, if I understand correctly, is that it actually creates the correlation by these positionings.
Yeah, it's absolutely right. The breakdown in correlation is mathematically a function of the index vol compressing, and that it's tied specifically to the index and not across all the constituents. And again, we have kind of plenty of historic precedent now to really back that up. It would be a huge coincidence to see, again, in 125 years of history, those two things dramatically break down in one year and not be tied to one another, right? So we have a pretty clear picture of how this is working and why it works, and it makes sense mathematically. It's simply an arbitrage trade, and by definition, it's self-fulfilling. The more the index moves, the more the single lists have to move away from one another.
Okay, so now, first of all, could you comment on the fact that the SIBOs made this index, and One of the thoughts that I originally had when I saw that they were making this dispersion index and they're trying to make a future is that, yes, they see a product that that there's a demand for, but it also might mean that there's more risk out there in this square than we might guess.
Yes. I mean, it's become very popular because it's profitable. And as we mentioned, there's a bunch of entities now betting that these things will continue. The problem is that assumes some level of index vol compression. And we continue to see that. And it does seem stable. And there are reasons to believe it will be in the short term because it's well distributed and not concentrated. But, what happens when vol is not well supplied to the trade, right? And particularly when it's that crowded, if it stops working, again, we all know the self-fulfilling prophecies of positioning. When things like this break, even though they seem highly improbable of breaking, they can break in magnificent ways and be very painful. In Feb to March of 2020, when COVID happened and we had an index-centric vol explosion, right? All these different trades in the index complex exploded. Some of this dispersion was already happening, and not to the scale of we're seeing now, but it had already become quite popular. And what we saw then, and I think this is kind of a clue to what will happen next time, it could very well be much worse because, again, the positioning is bigger, is we actually saw correlations not only decrease to 1, we saw them go negative. And that's a pretty, at least on an implied vol basis, that's a pretty hard thing to get your head around. But much like when oil went to negative 30 several years back, anything can happen to price, even if it's
right.
an arbitrageable kind of nonsensical thing. And I think people have a hard time often thinking about those scenarios. And it generally doesn't last long because arbitrageurs will come back in. But if there is a very levered trade here that can be very, very painful and is very and is again concentrated. Now we're starting to look at a more concentrated trade, right? This trade is concentrated in several big hedge funds books, and you have lots of big pods that are doing it. That could very well take down a big shop, right? And that's something we have to be mindful of and aware of. And now this trade is more and more tied to volatility in the sense of the level of volatility, because if index vol pops and single list potentially underperforms, now these trades could be so imbalanced in a liquid market that things can go really crazy.
You were on this podcast with Imran, and you mentioned that you said the dispersion trade is crowded, but it's rebalancing an otherwise unbalanced trade. And you said it was like two sumos bumping up against each other. It's balanced, but that doesn't mean it's not risky. I thought that was a fantastic analogy. Could you explain to us what you meant by that?
Yeah, I think there's another. I think somebody came up with a different analogy that's very similar. It's like two colossal plates on the core of the Earth, right? Pressuring against one another. It's not the same as not having that pressure. I mean, we may sit on this Earth and feel like sit on one of those massive fault lines and not realize and think that everything is fine and stable. But if you don't live on a fault line, it's not the same thing as living on a fault line. A fault line that has massive pressures with two things pushing up against each other in a meaningful way eventually will shift. These are two forces that are pushing upon each other really, really hard. And that eventually, just the smallest thing can lead to a massive earthquake. And I think that's, the same metaphor essentially as like these two sumo wrestlers going up against each other. They may be pressuring against each other and going nowhere. And you may watch and be like, oh, well, not much is happening. Then one's toe slips and the force gets pushed into two massive things end up moving in huge directions and kind of being a very dramatic kind of situation. So I think the more pressure we build in these systems with dispersion trades and other big trades, yes, you get this feeling of plasticity and that volatility is low. But what it does, it creates potential energy. And that potential energy in the system, not just in this trade, but across the board, is increasing in the last several years. And I think that broadly is something that we need to be very mindful of when we start looking at the risks that exist across the market.
The other thing that I've found, Cem, in my years in the market is that it's never the thing that everyone's worried about in terms of crisis. Like whatever everyone was worried about last time, it's not the same. And so I kind of look at this dispersion trade, and most people don't understand it. I know I certainly didn't until I started digging in, and then I barely understand it now. And it seems like it's just the kind of under the radar big trade that has more risk that actually could be a source of a problem that, I kind of laughed and said it could be a situation where a year from now, everyone's going to understand what a dispersion trade is because of what goes bad.
Yeah, absolutely. And the reason, the thing that everybody's thinking about, or that the last crisis doesn't happen, because reflexively, right? People are not taking that risk anymore. People are not, and people are positioning to potentially take advantage of that again. And so the odds of it happening are not. It's a story as old as time. I agree with you when it's a thing that people don't foresee that gets really big, and that seems like just an obvious winning trade. Those are the things that tend to be the things that blow up. And this very much could be that. There's a lot of leverage, and it's very concentrated in several entities. And again, I think that tends to be the recipe when you start to see a broad sumo market happening and all kinds of risk building. And if you're trying to figure out what it is that's going to set off the earthquake or where the epicenter is going to be, well, go look at the thing that you least suspect that's very concentrated and very leveraged. And this checks all of those boxes.
Okay, one that's not kind of under the radar and as fact is front court and on everyone's mind is zero DTEs. You recently went to a conference with some market makers and you spoke about and you kind of gained some insights in terms of how the risk is transferred. But one of the interesting things that I thought that you mentioned there was you said no regulation happens until something big and bad happens. And the reality is that currently there's no intraday margining.
It's pretty insane, right? We're talking about 40% of the option volume in the market. And we're talking about how tightly regulated margin and risk is across the industry otherwise. But for this 40% of margin, there is no actual regulatory requirement to post capital. Now they're starting to work on that. Again, I don't know that, me talking about it, others talking about it. It's speaking at a conference has definitely got some ears up and people are moving, but, regulatory agencies don't move particularly quickly. Margin is broadly done on a daily basis because that's when statements hit, that's when cash balances move, et cetera. And these trades, the zero DTE, happen within the course of the day and expire before that day is done. And so there's, not very clear requirements for margin on this. Now, most of the clearing houses do require some money and watch these things closely and whatnot, but that doesn't mean that, from a regulatory perspective, that's happening everywhere. And that tends to be a problem. That's one of the, I think I would classify two major problems with zero DTE. That one, I think they will kind of deal with sometime shortly. I would have thought they would have already acted, but again, I hear they're moving to fix that problem.
Okay, what's the second worry?
The second one I actually think is a bigger structural issue, and this was also highlighted at that conference. The reality is zero DT is such a concentrated risk in the sense of there's so much gamma with very little time to expiration. Market makers cannot hedge it with anything other than zero DTE. Think of it like the GME and AMC call squeezes. The problem there is market makers couldn't hedge that exposure with anything else. GME is not correlated to everything else, right? You either are long it or you're short it. And if you need to hedge your exposure, you better hedge it within GME or AMC or whichever stock you're looking at. That's how those squeezes got to such an irrational level. It's a closed circuit. It's at the end. It's an endpoint on a fabric that is the market. If you're in the middle of the market, if you're trading 30-day options, you can hedge it with 29-day and 31-day. And if you're hedging 5% of the money, you can hedge 10% of the money. If you're, there's depending on where you sit in the fabric, things are stable and less risky. But when you're talking about something like zero DT, it's very similar to these call squeezes and the meme names in the sense that you can only hedge it with itself. For now, that means things tend to be balanced. When you talk about Mandy Zhu and the CBOE has put out all kinds of research saying, look, market makers are very balanced on a day-to-day basis in zero DTE options. Why? because they can only hedge 0DTE with 0DTE. So it has to be balanced.
But
right?
don't
That's
they
not
delta
really,
hedge it? Like I would have thought that there was
they don't hedge it with futures. They can't. They can't. They hedge it with other options in 0DTE.
And they can't hedge it with futures because
these options have so much gamma to them that the delta changes so quickly that the stock does nothing for you.
Oh, they're just be chasing it around too much.
Yeah. Options go from 1 delta to 100 delta at this point, sometimes with a 5-point move, right? How do you hedge that with futures? You can't. You have to hedge gamma with gamma. And once you get to such a short time frame, and again, this was actually, they had the two biggest market makers or two of the biggest market makers on the stage talking about 0DTE. This question was asked and they confirmed. And again, I know this as an ex-market maker, but they confirmed they hedge their 0DTE with 0DTE because that's the only way to hedge it. And
that's got to also imply that last hour, it's crazy.
What does that mean? That means a cascade, right? A situation where somebody comes in and lifts all the 0DTE from dealers. And we saw this. It was a couple of weeks ago. Did you see that big blip when a 0DTE?
I can't.
We dropped 60 points in a day, like in about an hour.
Okay. And it was a function.
I forget. I have to go look the day. But there was a massive trade. And guess what? That trade that they bought some puts like 20,000 times in the SPX. I forget what the quantity was. 50 points, 40 points out of the money was in the money by the end of the day because everybody had to go chase at the same time. And that's what a cascade is. That's what happens with, again, GME, AMC, these other names. It doesn't matter if it's right or wrong. There's no other way to hedge it. So it becomes a gamma loop. And 0DTE is exactly that problem. If somebody sweeps the book and all the dealers have to hedge 0DTE to 0DTE, that then creates more buying of 0DTE puts or calls one way or the other. And that loop just keeps going. And there's nothing to stop it at some point. Now, it's very short term, right? These things, 0DTE is literally gone, put on today, gone tomorrow. So the good news about 0DTE is it doesn't generally create structural long-term issues. Long-term capital management was a big structural issue because it was long-term. These were long-dated options that were liquid, and the price of those can go to wherever, right? Because they don't expire for some time. 0DTE has a massive effect. It's very hard to hedge. It can create massive cascades within a day, but then it's gone. And so it just creates different market structure and different risks. But I think the biggest problem with 0DTE, other than this regulatory margining piece, is really this simple fact that it is a unhedgeable product outside of its own complex. And so that complex itself can create a illiquid environment where the gamma can really feed on itself and create a dramatic move in a very short period of time.
Okay, great stuff. So I'm going to end with one last insight that you had that I feel like I got to dig into a little bit more. You talked about the kind of clues about when sell-off might get worse. And you talked about watching the wings or the stuff with the most convexity.
Yeah.
Could you explain what you meant there and kind of how that would look, what that would look like?
Yeah, I think this is an important insight for people. Now, this is something that is a clue for tail risk. The biggest driver of crashes and this cascading effect that we see where big things, the big tails kind of happen in a very short period of time, are when people are forced to sell and or buy vol and options. And there's no better way to force the whole world, to know that the whole world is going to be forced to sell or for vol is going to be forced to be bought, then if they can't cover margin in their regulatory environments. Crashes tend to be a function of the simple fact that entities have to meet margin requirements and risk requirements. So once a trade gets going, once the market starts going down, if there's a problem with any margin requirements for any entity or broadly the market, that can feed on itself and become a very, very nasty situation. I've been doing this for 25 years now, every single time that's happened, you see before it happens a weakness in the supply of those margin puts. Those are the things that are the most convex and the most important during a stressful time in market, because they're the things that allow you to wait it out and to manage the risk requirements. Those things tend to be tiny kind of VIX calls, right? The most convex moment on the distribution, or nickels and dimes, little short dated, meaning 1 week out or 2 week out. Little units, nickels, dimes, 15 cents, things that really are the most convex moment, and it has nothing to do whether they'll be in the money or not, to be clear. I mean, if it's not really about whether the 3,700 put, right now in a week out or 2 weeks out or whatever it is going to be in the money. And that's what everybody's thinking. When they go sell them, they're like, these will never be in the money. The problem there is that at some point you'll be forced to buy them back, because the margin on them will be so big that you won't be able to hold them if the market declines to 4,200 or whatever. So those tend to be not just a sign that it's going to happen. They tend to be a driver, a reflexive driver of crashes. And so if you watch those most convex moments of the distribution, both, again, nickels, dimes, 15s, margin type puts on the short end of the curve, as well as you look at the, again, VIX calls, particularly the smallest nickel, dime, 15 cent VIX calls, those are generally a very, very good indicator of a crash on its way.
So just to be clear, those are like 3, 5, 7 day options that are way out of the money put options. And when you say like nickel, dimes, like that means the price of the actual options are low. And so they might go from 10 to 20 cents. And then that might be a move from 30 vol to 50.
Yeah, I mean, prior to the XIV crash day, for example, that's when we all kind of know, options that were trading, and this is before the market declined that day and before the implosion happened. Going into the close, the last hour, we saw nickel 5 cent and 10 cent options trade up to about 50, 70 cents. They really started to pop in the last hour. And then the next day we opened up and they were worth $10. And you don't see them go from a nickel to 50 cents very often. And I will say, if you do, don't sell them, buy them. Because the next trade, they will be worth, again, dramatically higher.
That's a great line. You know what? I was gonna end there, but I have one more thing that I thought to myself, I had this other question for Cem, and maybe we could squeeze it in. Vixpiration. Why does that end up being a change in market direction at times?
So I want to be clear. I tend to circle that and point to Vixpiration more than I do monthly options expiration, because it's the two of them that matter together.
Okay.
And the Vixpiration itself is really the last moment of vol, not the last, but the most kind of the biggest and before the end of the monthly expiration, the last kind of supply of vol. There's a big trade that happens in the VIX, where across the board, because of VIX demand, the VIX tends to be higher than the options chain that it's tied to, right? The 30-day options chain. And that strip of options tends to be arbitraged across it. So what do people do? Market makers go sell the VIX, futures, and they go buy the strip of options that they expire into. This is a common and ongoing trade, and there's an edge in it. Well, what happens when the VIX expires? There's a strip where the people get delivered the options on that side, right? And they have to go sell the actual S&P options that they are long against it, right? So there's a vol supply moment. There's a compression in this spread, and vol gets supplied on the morning print on Wednesday.
Okay.
And so when that is done, when that trade is done, that's at least a significant portion of the last vol supply that is structural that comes off the board. Now, there's more of that still comes from options expiration and other trades, but that's a big one. And it's also getting to the point where the options expiration itself is only a portion. So there's just less vol supply at that point. So that would be the reason. Again, it's not just one point. It's not the spot that everything has to turn, but it is an important one. And again, I paired with Friday morning of AM prints on the options expiration as well. Those two things represent a very important 2 points in structural supply and demand in the vol space that really need to be paid attention to.
Cem, you know what? You are such a kind individual to come and take the time to explain all this to us, and I really appreciate it. For those who want to learn more about yourself and your firm, why don't you just give them the URLs one more time?
Yeah, Kai Volatility Advisors. We manage several hedge funds, both hedge products, long vol, as well as absolute return products in the space. We look at dealer positioning a lot, as well as I've mentioned. You can find us at kaivolatility.com. And if you want to subscribe to some of our media and what we put out, kaivolatility.com/news. Thanks for having me.
Thanks, Cem. Thank you. I really appreciate it.